everyone, and welcome to this economic impact video. June 14, very timely. The markets are volatile and there's a lot of pessimism out there. As usual, I'm here to discuss many interesting topics with our chief economist, Stéfane Marion. Hello, Stéfane.
Good morning, Martin.
So, Stéfane, we're now in bear territory pretty much everywhere around the globe.
Yeah, bear market territory, which means that stock markets are down 20% from peaks. Emerging markets are down more than that. Technology stocks, NASDAQ, close to 30%. And the S&P 500 joined the rest of the club earlier this week, down 20%. Note, Martin, however, that the S&P TSX continues to show resilience, down 10%. So again, we've said many times before that if you were concerned about the slowdown, stagflation fears, Canada was a way of being more defensive, and that's still the case. Even though the index is down, the relative outperformance is still quite significant.
So, Stéfane, earnings usually drive the stock market, but now it's really all about interest rates.
Yeah, Martin, we get a lot of questions as to, is that what's driving the market down? Is it a contraction in earnings? This hasn't been the case. In fact, globally, profits are still rising. But what's happening is that long-term interest rates are rising, and normally there's a trade-off between investing in the stock market versus the bond market. And with bond yields on a significant uptrend, what's happening, Martin, is you have this compression in price earnings multiples. So it really is the stock markets that are trying to find their fair value according to the level at which long-term interest rates will stabilize.
And what's behind this, obviously, is much more resilient inflation than what we believed a couple of months ago.
Well, stabilizing the bond market means you have to stabilize inflation, Martin. And unfortunately, inflation is proving to be more resilient than we thought. Headline inflation, the blue line on the slide, running at close to 9% year over year. And even when you exclude food and energy, we're still talking about 6%. So under these circumstances, the market is saying that obviously the central banks will have to be a lot more aggressive and perhaps even more, even provoke a recession to bring inflation down. That's the concern that we see in the markets right now.
And we're not only talking about typical economic cyclicality here. We still have some pretty important impact from the pandemic.
Well, the issue I have about the scenario where central banks are dumb and they're just going to raise interest rates to kill the economy is the fact that we still have supply-side components that are impacting inflation. And one of the key points is China, Martin. The pandemic is not behind us. China has shut down its economy over the recent weeks. And if they would start to reopen, I believe they will later this summer or in the next few weeks, that would bring significant relief to the global supply chain and help bring down inflation. To give you a sense on how much these pressures are still very much present on the global supply chain, you can look at the slide of the pressure slide from the New York Fed. You can see that we're almost as elevated as we were back in 2020. So clearly, a reopening of the Chinese economy would certainly help bring down inflationary pressures, particularly on the goods segments. So I'm hopeful that we're likely to see this reopening and deceleration in inflation. So again, there's more than demand-side components. Supply is still very much at play, Martin.
Something that we don't hear a lot about is the state of the consumer. And, that's one of the key components of our thesis. The consumer is feeling the pinch right now.
Yeah, and that's where I'm a bit surprised that the markets are so aggressive in anticipating Fed tightening. It's as if there's no slowdown on the horizon. And Martin, if you look at consumer sentiment right now, the blue line on this slide, it's at an all-time low going back to the 1950s. So clearly, the consumers are feeling the pinch from higher food prices, higher energy prices, rents are moving up in terms of inflation, and also debt financing with mortgage rates on the rise are also impacting the purchasing power of consumers. So to me, Martin, that chart suggests that we will see a slowdown. Will it be a contraction? I don't think so. You can see the red line labor markets are still quite strong in the US, But I think there's a tangible slowdown around the corner. And if you get this tangible slowdown, which doesn't mean contraction, by the way, doesn't mean recession necessarily, but the slowdown will help stabilize inflation. So that's why we're a little bit less aggressive in terms of rate hikes than what the market currently expects.
Now let's talk about Canada faring a little bit better than the United States.
Well, not a bad place to be when you consider that our economic surprises are clearly outpacing the rest of the world. So, economic surprise in Canada is showing up tremendous resilience, and that has to do with the economic structure of our economy. Profits are still growing. And what that means, Martin, it also translates in a job market that is the best we've seen since 1974.
And purchasing power for Canadians.
Well, that's a big difference between the two countries because the labor markets are strong and at the same time, real wages, so wages adjusted for inflation, are rising more rapidly than we see in the US, where it's been stable for the past, well, actually, since the start of the year, Martin. So this gap between Canada and US argues for a Bank of Canada that is likely to prove slightly more aggressive than the Federal Reserve. So this differential in interest rates that favors Canada and that could lead to currency appreciation, I think is still in place for the next few months. Again, this resilience in labor markets argues for a central bank that will be a little bit more aggressive in raising rates in Canada, but I don't think that will move into an environment where we create a recession in Canada. But yes, you could argue that there's more room to raise interest rates in Canada than in the US at this point in time.
And our listeners, Stéfane, keep reading and hearing that this is going to have a negative impact on real estate in Canada. Any thoughts on this?
Martin, it will slow, okay? Let's not kid ourselves. With higher mortgage rates, the sector will cool. Will the sector collapse? I don't think so, because we still have the best demographics in the generations. If you look at the population growth for people aged 25 to 54, it's up roughly 200,000 individuals on a year-over-year basis. That's the best we've seen since 1974. Obviously, this reflects our immigration policy, which has benefited the country and helped supports the residential sector. So, Martin, I'm very open to a cool down in the residential market. Yes, prices will also slow or might decline a little bit, but a collapse is unlikely given the very good demographics, and you will offset the impact of higher rates with this demographics. So I think the slowdown will be more temporary than permanent given our demographics. So cool down to be expected, collapse, that's not a baseline forecast.
Excellent. Thank you, Stéfane. So in conclusion, I think it's fair to say that monetary policies around the globe have not stabilized yet. We're still fighting inflation worries around the globe. We now believe that interest rates could go a little higher, around 2.5% in the United States, 3.5% in Canada. But Stéfane, stock market, a lot of negative is priced in?
Martin, tremendous pessimism priced in at this point in time. So the issue at this point in time is, do we get the stabilization in inflation in the coming weeks? Will the Chinese economy reopen? I believe it will happen. I believe we're going to see a slowdown in the hiring pace in the US that will also help cool consumption and inflation. When it stabilizes, Martin, you get the stabilization in long-term rates, and then your stock market will find its proper level, its balanced level, its neutral level. So our view is that a lot of people fear a recession call right now, recessions, and our view is that the central banks will raise interest rates, but are unlikely to push it in restrictive territory as to create a recession. So slowdown is our baseline forecast, not a recession. I think the combination of higher long-term interest rates with the Chinese reopening will cool the inflation backdrop in the coming weeks. So our baseline forecast remains for an economic slowdown, but not a recession. And we should get better news in the coming weeks on the inflation picture.
Excellent. Thank you very much, Stéfane. Thank you for listening. And if you have any questions or comments, don't hesitate to reach out to your advisors and stay safe. Take care.